In today's episode, I want to take a deep dive into the trade dynamics between the United States and Europe, especially in light of recent statements from Donald Trump. As he prepares for a potential return to the presidency, he's making headlines again by threatening to impose additional tariffs on the European Union unless Europe agrees to buy more U.S. oil and natural gas. This comes after his earlier threats to Mexico, Canada, and China, where he vowed to apply tariffs of up to 25% on goods from Mexico and Canada and an additional 10% on Chinese goods. Trump's reasoning? He believes that countries like China have allowed the trafficking of fentanyl into the U.S. and that trade deficits need to be addressed to level the playing field. Let's explore these claims and see if Trump's reasoning holds up or if these moves risk igniting a trade war, particularly with Europe. The U.S. trade deficit with Europe. One of Trump's key points is the trade imbalance between the U.S. and Europe. He argues that the European Union exports far more to the U.S. than it imports, creating a significant trade deficit for the U.S. Let's look at the numbers to see if this is the case. The U.S. Census Bureau's data from 2023 shows that the United States exported $367.8 billion worth of goods to the European Union, but imported $576.3 billion worth of goods, resulting in a trade deficit of $208.5 billion. The latest data for 2024 indicates that this trend has continued, with the deficit for the first 10 months of the year running at $193 billion. Now, if we look at the European Union's export destinations, we see that the U.S. is by far the largest single destination, accounting for 22% of all EU exports. However, when we look at the imports, China is the EU's largest trading partner, accounting for a larger share than the U.S. The United States represents 13% of the EU's imports, compared to 22% for exports. So, on the surface, Trump seems to have a point. The U.S. is importing far more goods from Europe than it is exporting, and Europe is benefiting from this imbalance. But this view only considers trade in goods, not services, something the U.S. has a significant edge in: the role of services in the trade deficit. The data we've discussed so far only looks at physical goods. But to fully understand the trade dynamics, we also need to account for services. The U.S. is a global leader in providing services, especially through major companies like Google, Microsoft, Meta, formerly Facebook, and others. These companies don't export physical products. They provide services that generate revenue without any physical goods being moved across borders. The European Commission provides data on services trade, showing that in 2023, the U.S. exported $396 billion worth of services to the EU, while importing $292 billion in services from the EU. This resulted in a trade surplus for the U.S. in services of $104 billion, or around $115 billion. When we factor in this services surplus, the overall trade deficit between the U.S. and Europe shrinks significantly. From an initial goods deficit of $208.5 billion, the net deficit for the U.S. drops to just $93 billion. While there is still a deficit, it's much smaller than the trade imbalance in goods alone, suggesting that Trump's focus on the goods deficit may be somewhat misleading. The U.S. and the export of oil and gas. One of the central points in Trump's rhetoric is the idea that the U.S. can solve this trade imbalance by selling more oil and gas to Europe. But is this realistic? Let's take a closer look at the data. The U.S. is the world's largest producer of oil, producing nearly 22 million barrels per day in 2023, or 22% of global supply. However, the U.S. is also the largest consumer of oil, using over 20 million barrels per day, which means the U.S. only has about 2 million barrels per day available for export. Of those 2 million barrels, half of it is currently going to Europe. So, if the U.S. wants to send more oil to Europe, it would either have to reduce exports to other countries or significantly increase production. The latter is not simple, as there are logistical challenges and investment hurdles involved in boosting production on a large scale. Moreover, if the U.S. redirects oil exports to Europe, this wouldn't generate additional revenue. It would just shift sales from one region to another. So increasing oil exports to Europe may not solve the trade deficit problem as Trump suggests. Natural gas production and export. The situation is somewhat different with natural gas. The U.S. is also the largest producer of natural gas, producing 32.9 trillion cubic feet in 2023, a significant surplus after meeting its own consumption needs. The U.S. has been exporting large volumes of liquefied natural gas, LNG, and Europe has been a major recipient of those exports. In 2023, 47% of U.S. LNG exports went to Europe. However, there are challenges in increasing the volume of LNG exports. LNG must be converted into a liquid form for shipping, and Europe needs sufficient infrastructure to import and regasify this LNG. Europe has been rapidly building up its LNG import facilities in the wake of the Ukraine war, as it shifts away from Russian gas. But expanding this infrastructure takes time and significant capital investment, so it's unlikely that Europe can quickly scale up its LNG imports to meet Trump's demands. Moreover, Europe is making significant strides in transitioning to renewable energy sources, which could reduce long-term demand for natural gas. Therefore, the scope for significantly increasing LNG exports to Europe is limited. The tariff issue and global repercussions. Donald Trump's threats to impose tariffs on Europe, just as he has with Mexico, Canada, and China, are designed to address the trade imbalance, but they could trigger significant consequences. If the U.S. increases tariffs on European imports, the European Union is likely to retaliate with its own tariffs on U.S. exports. In fact, Mexico, Canada, China, and the EU have all indicated that they would impose counter tariffs if the U.S. moves forward with these measures. This would escalate trade tensions and result in higher prices for goods on both sides of the Atlantic. The impact of higher tariffs would likely drive up inflation, as consumers would have to pay more for imported goods. Higher inflation would push central banks to raise interest rates, slowing economic growth. In the long term, this could lead to a slowdown in global trade and a potential recession in major economies. In this sense, Trump's approach risks damaging the global economy rather than improving the U.S. trade position. Conclusion. In summary, Donald Trump's assertion that the U.S. is at a disadvantage in its trade relationship with Europe has some truth when you consider the trade deficit in goods. However, when we account for the U.S. services surplus, the actual deficit is much smaller. While Trump's push for more oil and gas exports to Europe may seem like a solution, the logistical challenges and Europe's shift towards renewable energy make it a difficult task. Furthermore, increasing exports may not solve the underlying problem of the trade deficit. It could just shift trade flows without significantly increasing overall revenue. Finally, the proposed tariffs are likely to provoke retaliatory measures, leading to higher costs for consumers and possibly triggering a broader economic slowdown. In the end, Trump's trade policies may spark a trade war that harms global trade rather than improving the U.S. economy. Thank you for watching this detailed analysis. If you found the video useful and informative, please give it a thumbs up and feel free to share your thoughts in the comments. Let's continue the discussion on these crucial global economic issues.